You guys, unfortunately my camera stopped recording. So this is the first example we are going to solve. A company commenced business on February 1st 2020 and makes up its accounts to March 31st every year. It acquired property, plant and equipment as follows. So these dates that you can see are the dates of acquisition. You see, on 1st of February 2020, they bought building at 5 million. 1st of February 2020, they bought furniture at 1.5 million. And 1st of April 2020, machinery at 2 million. 3rd of May 2020, Jeep motor vehicle at 3 million. Then they said the turnover for each of the relevant years of assessment was over 27 million. That line is just giving you a hint that they can claim capital allowance. Then required says determine the basis period, that's one, and compute the capital allowances for all the relevant assessment years, taking into consideration the relevant provisions of the Finance Act 2020. So let's solve this question. I'm so sorry that I'm not writing on the board. I would have loved to write on the board, but at the point of editing I realized that everything I was doing was not being recorded. So just like the question required, we are going to start with determining the basis period. You know that this capital allowance is related to company income tax. So you can start with the basis period for company income tax. And remember that in my explanation, I said the basis for capital allowance is always on preceding year basis. In fact, it is stated in the ICAM pack that the way you determine basis period for company income tax is the same way you determine basis period for capital allowance. So it is always on preceding year basis. Now they said this business commenced February 1st 2020 and makes up its accounts to March 31st. It means that the first set of financial statements will be just 2 months, that is 1st of February 2020 to 31st of March 2020. That will be the basis period for company income tax in the first year of filing. Okay, so the basis period for capital allowance would also be 1st of February 2020 to 31st of March 2020. So that's for building. Okay, now the year of assessment will be 2021 year of assessment, not 2020. Remember that there's no more old provision. It's going to be 2021 year of assessment, and this follows the preceding year rule. Then for furniture, which was also purchased 1st of February 2020, the basis period would also be 1st of February 2020 to 31st of March 2020. Now look at machinery. Machinery was purchased 1st of April 2020. If a company closes its account 31st of March every year, it means that 1st of April, right, is the start of the accounting year. So it means that this 1st of April 2020 is the start of the next accounting period. Does that make sense? So let us just write the accounting periods, the possible accounting periods for this company. You have 1st of February 2020 to 31st of March 2020. After 31st of March comes 1st of April 2020, right, to 31st of March 2021. The next will be 1st of April 2021 to 31st of March 2022. And the years of assessment, the tax years, will be 2021, 2022 and 2023, right? This makes sense. Now let's go back to determining the basis period. You would have 1st of April 2020 to 31st of March 2021. That's the basis period for company income tax for this second year of assessment. Okay, then the capital allowance would also follow that same basis period. Just always keep at the back of your mind preceding year basis. So that will be 1st of April 2020 to 31st of March 2021, and that's 12 months. So let the preceding year rule guide you. Now for this Jeep motor vehicle that was purchased 3rd of May 2020, the basis period for company income tax will also be 1st of April 2020 to 31st of March 2021. Then the basis period for capital allowance would also fall within that year. So you can see that in the first two assets, building and furniture, it was just 2 months. So when we are computing annual allowance, we would prorate. Because a year is meant to consist of 12 months, but the annual allowance would only be given for 2 months, right? Because that asset has stayed for only 2 months in the first year, right? Now, let us go to the second part of the question, which says compute the capital allowances for all the relevant assessment years. So to compute capital allowance, the first thing you need to do is to list out all the assets involved. What are the qualifying capital expenditures involved? So you have building, you have furniture, you have machinery, you have motor vehicle, and you must also write the total, because the reason why you are calculating capital allowance is to know the total capital allowance so that you can charge it against your assessable profit while computing company income tax, right? So you must always write the rates. What are the initial allowance rates and what are the annual allowance rates? You guys already understand all this if you watched the introduction video I posted earlier. Then you must also put your currency, right? Is it naira, is it dollar? You must also put that. You might have to abbreviate the currency, that's putting it in thousands. Then you now start write out all the costs. What is the historical cost? That is how much was spent. What is the qualifying capital expenditure that was incurred on each asset? For building, you have 5 million. For furniture, you have 1,500,000. For machinery, you have 2 million, and for motor vehicle, you have 3 million. Then you start year of assessment. You start from the first year of assessment. The first year of assessment of this company is 2021. It is not 2020. The company is not going to file tax in 2020, because now company income tax and everything that associates itself with company income tax is now on preceding year basis. Okay, so the first year of assessment is going to be 2021. Okay, the first thing you will grant is initial allowance. And the rates are usually given. You can see for building 1510, furniture 2520, machinery 50%, 25%, motor vehicle 50%, 25%. So you grant initial allowance for every asset that was purchased in the first year of assessment. So look at it. Which asset was purchased in the first year of assessment? Hmm? Even if everything was purchased in 2020, but it does not mean that everything falls in the 2021 year of assessment. Okay. 2020 accounts is what you do in 2021 year of assessment. Okay. So you have building, and the initial allowance rate for building is 15%. So you say 15% of 5 million, and that will give you 750,000. Then you also have furniture, which is 25% initial allowance. You say 25% of 1,500,000, that will give you 375,000. Initial allowance is granted just once. So once you purchase the asset, you grant initial allowance and you forget about it. Okay. Then annual allowance is what you grant every year, and it's granted on a straight line basis. So what you grant in year one is what you grant in year two until it is exhausted, and you retain 10 naira in the books as long as you not dispose the asset. So how do you get your annual allowance? Ask yourself, what is the value of the asset that is left after I have charged initial allowance, right? The value of the asset is 5 million. When you charge initial allowance of 750, what will be remaining is 4,250,000, right? It is that amount that is left. You will now spread over 10 years. Why are you spreading it over 10 years for building? Because it is 10%, right? So if you take 10% in year one, in year two, 10% in year three, 10%, by the end of 10 years, you'd have chopped it finish. Sorry. By the end of 10 years, you'd have exhausted it. Do you understand? So that's why it's 10 years. So the best way to know that thing is to say 100% divided by 10%. So you get 10. You can see that for furniture, which is 20%, is going to be 5 years, right? 100% divided by 20%. That's just common sense, right? So you now spread that 4,250,000 for 10 years, and that will give you 425,000 of annual allowance every year, right? So in 2021 year of assessment for building is going to be 425,000. However, they cannot claim 425,000. Why? Because the asset represents only 2 months in that year of assessment. Okay, the assets represent only 2 months before they close the account. So you say 2 over 12 times 425,000. Does that make sense? You say 2 over 12. That's how to calculate your annual allowance. 2 over 12 times what is allocated to 1 year itself, and that will give you 70,833. So let's just approximate to 71. Okay, so that's what you're going to get for your annual allowance for building. You ask yourself, which other asset falls in the 2021 year of assessment? Don't forget, 2021 year of assessment means 1st of February, right? 2020 to 31st of March 2020. Because the close account, when the close account is very important in determining basis period, because the close account in March. Does that make sense? So another one must start in April. Do you understand my point? So that's why you have it for just 2 months. That's how we are getting the 2 months out of 12 months that annual stands for. Annual allowance. So that's why you're having just 71,000. Okay, so we've already moved to furniture. Furniture, the value is 1,500,000. You grant your initial allowance at 25%, and that gives you 375,000. Okay, then how do you know your annual allowance? You say, what is the value left after charging initial allowance? That value, you will spread it over 5 years because it is 20% annual allowance rate. Does that make sense? So you have 1,500,000 minus 375,000 initial allowance. That will give you 1,125,000. Then you divide by 5 years, right? You have 225,000. So for year one, right, of that asset, you'll get 225,000. Year two, year three, year four, year five, until it is exhausted for 5 years. Okay. So since in the first year of assessment, they can only claim for 2 months because only 2 months is represented. It does not mean that the asset lived for only 2 months. This thing is accounting, is as in this is what happens. How do I put it? It does not mean that the asset lived for only 2 years, only 2 months, so the asset is still alive. But it's about periodic reporting. Do you understand? In that report, in that financial statement, it's capturing only 2 months. So it's only things that relate to 2 months that you capture. That's why we are prorating. That's why we say 2 months out of 12 months times 225,000. So it's only 37,500. That's 37,500 we are going to represent there for that year. So we can just approximate that to 38. It's because I'm putting it on screen. Don't approximate like that too much in exam. You understand? So because our own is abbreviated, that's why I'm approximating. So you have, let's say, 38 as your annual allowance. Okay. Now you go to your next asset, machinery. Machinery costs 2 million. Does machinery fall in 2021 year of assessment? No. Look at the basis period. It doesn't fall in 2021 year of assessment. It falls in 2022 year of assessment because the date you bought machinery, remember, was on 1st of April 2020. Everything is still in 2020. But in reporting, right, it falls under 2022 year of assessment because it falls between 1st of April 2020 to 31st of March 2021 accounting year. So an accounting year that ends in 2021, it means the year of assessment or the tax year is 2022. Okay? Anything that ends in 2021, they won't tax it in 2021, they will tax it in 2022. That's the rationale behind preceding year basis. Does it make sense? So it means that machinery is not in 2021 year of assessment. So you can just say that the total capital allowance you cast and you put it there, right? So for machinery and motor vehicle, it's just going to be dash dash dash. Then you go to 2022 year of assessment. You know, they said the relevant years. They're not the one that will tell you relevant years. You're the one that would know the relevant years. You have to prove that you understand it. Okay. So you write your cost for your machinery, 2 million, you bring it down, and the cost for your motor vehicle, 3 million, you bring that down. Now, the cost for the building also and furniture cannot remain at 5 million and 1.5 million. They have now reduced to what? Their new tax written down values. Okay, so you bring down those tax written down values. Does it make sense? You bring them down. Now, you won't charge initial allowance again on the assets that you've already charged initial allowance on. You've charged on building, you've charged on furniture. The only thing you charge initial allowance on is machinery and motor vehicle, right? Because they fall in the 2022 year of assessment, but you will charge annual allowances. Annual allowance is always charged every year. You charge it for building and furniture, but you won't charge initial allowance for them. It is only machinery and motor vehicle you will charge initial allowance for, and you would also charge annual allowance for them. Okay. Now, let's start from building. Your annual allowance, right, is going to be 425,000, like we calculated earlier, because this one is representing 12 months. For furniture, it's going to be 225,000 because it is representing 12 months. Now, for machinery, you are going to calculate your initial allowance first. It says 50% is the rate, 50%. So 50% of 2 million, that's 1 million. You charge that. Then, to know your annual allowance, remember I say you say cost minus initial allowance, right? And you spread the balance over the number of years. So we'll say 2 million minus 1 million. The remaining balance will be 1 million. Then you say 1 million divided by 4 years. How do you know it's 4 years? Because the annual allowance rate is 25%. Or you just apply 25% on the 1 million straight, you will get 250. Also, if you divide by 4, you will get 250. Okay. So the reason why you always use years is just for you to be aware that it will expire at so year, so that you don't just keep charging and forget. Anyway, to start giving you a negative balance if you keep doing that. So you less your 250,000. Okay. Then you go to your motor vehicle. So for motor vehicle, you want to charge your first annual allowance, right? So you say 3 million minus 1.5 million. The balance will be 1.5 million. Then you spread over 4 years, right? Because the rate is 25%. Now look at when they said they bought this asset too. They said they bought it 3rd of May. So that's, let's say, at the beginning of May. It means they didn't start from April. So that tells you that it's just 11 months out of 12 months that is represented. That's what I'm saying here. Oh. That's what I'm saying here. Can you see? It is only they bought it May. So let's count, because the accounting year starts from 1st of April 2020 to 31st of March 2021. So if an asset is being bought, it came into existence at the beginning of May. It means it can't spread over 12 months. It is only spread over 11 months, right? So we can say 11 months divided by 12, right, times 375,000, and that will give us 343,750. So we can say 344,000. Okay, so it's not going to be 375,000. Is in the next year you now charge your full 12 months, definitely, right? So this is how to calculate, this is how to determine basis period. So it is not really the calculation of allowance. You already know that they will give you rates. Those ones are straightforward. It is how to determine the basis period, how to know when to prorate. That is kind of tricky, especially when it's dealing with commencement. If it's a business that is in existence, it's not really a big deal. So after that, you would add your capital allowances and get your tax written down values. So there's no any other relevant year of assessment, right? Because no asset was purchased in 2023 year of assessment. Of course, everything was purchased in 2020. So guys, please let me know if it is necessary to solve an example on carryback of capital allowances when there is cessation of business. And don't forget to give this video a thumbs up and subscribe if you have not. Please, if there is no comment asking me to do carryback example, I'm not going to bother myself to do it. So just let me know if it is necessary. Thank you for watching. Bye.